I'd like to provide some updates on the market indicators we're watching following the collapse of FTX last week. Overall, while other firms may face insolvency, many market fundamentals remain stable. Reporting suggests FTX situation stems from financial fraud rather than a blockchain or crypto-specific failure. One of the first questions I had when this whole thing happened was, are people exiting crypto? And we can measure that by looking for US dollar trades against cryptocurrency on exchanges. And while in the immediate aftermath of the FTX crisis, there was an increase in US dollar denominated trades on exchanges, that's largely died down now to levels that we were seeing immediately before the crisis happened. The next metric that we looked at was net inflows to exchanges. And after staying roughly flat last week, net inflows to centralized exchanges have dropped and are below zero in most hours, meaning users are withdrawing more than they're depositing. This may reflect concerns that more exchanges will face solvency issues and halt withdrawals. So where are those funds going when they leave exchanges? Mostly to other centralized exchanges. But we've also seen spikes in funds sent to personal wallets for safekeeping and to DeFi protocols. The increase in funds sent to DeFi is especially interesting, as many have reported huge spikes in decentralized exchange trading volumes in what's being framed as an embrace of self-custody. Our data confirms that DEX transaction volume has indeed increased, but there's more to the narrative. CeFi to DeFi flows have increased, but they're not the driving force behind DEX transaction volume. 90% of funds going to DEXs are coming from smart contracts associated with other DEXs. Since November 12th, the second biggest source is a single arbitrage bot called an MEV bot. The role of this MEV bot becomes more pronounced when we get more granular and look at specific smart contracts sending funds to DEXs. Since November 4th, that MEV bot is the third biggest source of funds sent to DEXs. Overall, the data suggests that the DEX trading spike isn't primarily driven by inflows from CeFi users looking to self-custody. Rather, it's driven by existing DeFi users trading on the volatility in the market. We'll continue to monitor for updates and share as much as we can. To summarize, while we see that people exiting crypto for fiat has largely stabilized, we do continue to see that trust in the industry has been shaken, as indicated by people moving crypto off CeFi into personal wallets. And we also see a noted increase in arbitrage activity in the DeFi space, as previously active DeFi insiders continue to take advantage of price volatility.